Let's talk a little bit about individual retirement accounts, most commonly known as IRAs. This is not a comprehensive report by any means. It's kind of a high-level 50,000-foot view, but I wanted to kind of answer a few questions that I get a lot about what is the difference between traditional Roth or maybe your employer-sponsored plan. So the three main types, again, are your traditional IRA, and these are IRAs that you make the contributions to yourself. The Roth IRA is also contributions that you make yourself. Your employer-sponsored plans, including 401ks, 457s, and those accounts, are contributions made by both you and, if you're lucky, a matching portion from your employer. So now again, remember, these three main types of plans, there are sub-accounts and subtypes underneath them, and they may be held in different types of vehicles like CDs at the bank, mutual funds, other stock accounts, sometimes annuities, variable or index fixed annuities. So again, this is not a comprehensive report. This is kind of an overview. So what are the other differences between these accounts? Well, on your traditional and your employer plans, you can contribute subject to income and IRS limits, and those are posted every year. They change from time to time, but they stay pretty consistent. Contributions are made from pre-tax income, meaning that you will either get a deduction if you just make your own contribution to a traditional IRA. If you make a contribution and your employer matches it through an employer-sponsored plan, then those will be done prior to taxes being assessed to your wages. Withdrawals are then set to begin at age 72. Uncle Sam isn't going to let you put pre-tax dollars over to the side and never get any of it. So as of January 1 of this year, the age has been extended to age 72. You might have been familiar with the 70 and a half rule that changed January 1. So you have a little bit longer before you must begin taking withdrawals, but you are required to take minimum distributions. Now your 401k and employer-sponsored plans will have a different chart and different percentage you're required to take than a traditional IRA. So be careful about that. Make sure you're working with a tax professional that can help you make sure that you're taking out the minimum so that you're not subject to other tax penalties. That's a topic for another time. If you want to go into that, I'll be happy to visit with you one-on-one. When you do take out withdrawals from your 401k or other employer-sponsored plan, or even your just traditional IRA, it is 100% taxable. Everything you put in, which is your principal, plus any gains you've made. Hopefully, if you've put it into a vehicle, you've earned some interest or your stock has grown, whatever the case may be. The idea is that you would have grown your money so that you have a nice retirement nest egg, but your principal and gains are 100% taxable. So your net income to you or your net withdrawal to you is going to be a little bit less than what you might be expecting. Now, your Roth IRAs are also subject to income and IRS limits with regard to how much you can contribute. But contributions are then made with after-tax funds, and this is significant. You don't get a deduction while you are contributing in that tax year. So if you need that deduction, then the Roth IRA may not be right for you. But if you don't, there are some advantages later. First, withdrawals are never required, not at age 72 or even older, because you've already paid taxes on the principal. Uncle Sam doesn't look at this the same way. When you do take withdrawals to supplement your retirement or for any other reason, the withdrawals are not taxable. Now, there are some rules with IRAs with regard to age, like the 59 and a half rule, which I'm not going into on this. So when I say they're not taxable, there are some rules around that, but as far as for retirement income at retirement age, your withdrawals are not taxable. This includes both principal, since you've already paid tax, and interest. So if you have a good retirement plan and you've made 3 or 4 or even more, You don't pay taxes on those gains. You can't even do that with a CD at the bank. You put money in and they send you an interest statement every year that you pay taxes on it. That's the key advantage to a Roth, is that you never pay taxes on the gain. So which type of plan is right for you? Well, there is no one size fits all, so that depends. That's usually my answer for most things. That depends. So we should sit down and talk about what your current situation is. Do you need a tax deduction this year? If you need the deduction, then the Roth may not be the most advantageous account to put it in, or type of account. Other things are like your retirement goals and needs. What do you expect your expenses to be in retirement? How much debt do you still expect to have? Do you expect to have any debt? Will you be working part-time? Will you be working full-time up until a certain age? There are a lot of different factors that go into deciding which product to use and which type of account to use. So we don't want to just blanketly say that one is better than the other. Lots of people actually use a combination of plans. So if you'd like to visit with me, we can sit down and do a financial plan, including which type of retirement accounts are best for you based on your needs, your goals, your current situation. The best idea is to work with a financial coach, such as myself, and a tax professional, so that you can clearly understand how the different products and contributions will affect you. I don't give tax advice. I can talk to you in very general terms about how taxes work and which types of accounts are taxable and which parts of the accounts are taxable. And I know when the penalties are assessed. But for your personal tax needs, we really want to work with a CPA, because there's a lot of stuff that goes into tax laws and they're the professional there. I'm the professional on the side of knowing which accounts are good for you as far as what types of gains you could expect, what types of withdrawals you can take without penalty, and that sort of thing. So I have a CPA that I work with, that I refer to. If you have your own, that's fantastic. But really working with both professionals is the best idea to make sure that you get the right type of account and then the right product for that account. Again, it's Melissa McNana. I'm your independent financial coach. You can find me on the web. I have my site at melissamcnana.com. I'm also on Facebook and LinkedIn. Feel free to shoot me an email, call, or text me at my cell phone number here. And I'd love to visit with you about your personal needs. If you have further questions just about this, just shoot me a quick message. I'll be happy to answer. If you want to set an appointment, you can do that via phone, or I have a link on my Facebook page. You can set an appointment directly from there as well. All right, guys. I'll be answering some more questions soon in some future videos. If you have any questions in the meantime, I look forward to hearing from you.